Hey, everybody.
Welcome back to the Get Your Money Right podcast brought to you by Forward Motion. I'm Sarah on the board of Forward Motion.
Hey, Sarah. I'm Amanda. I'm the CEO and the founder of Forward Motion. And Forward Motion's mission is creating generational prosperity one family at a time. The purpose of our podcast here is for us to deliver how all of that ties in. Getting your money right ties in with your finances, career development, your mindset. We kind of meld all that together. We talk about everything from entrepreneurship to meditation. So we're going to get today's episode going, and we've definitely got an episode for you today. But before we get going, I think, Sarah, did you have a question?
I do.
Or an interesting fact?
Today, it's actually a question. Although to follow up on our last episode's interesting fact, I found out nothing more about the Vaseline swallowing. I'm sorry to say. I cannot produce any more information on why the gentleman who created it decided he needed to take a spoonful of it every day.
Thank you for continuing that research journey.
Yeah,
I really appreciate it.
Multiple sources left it at just that. So who knows?
Did you try back rub?
Yeah, I did. I used back rub. Okay. So, and if you didn't want to know what we're talking about, you got to go listen to the last episode. Today, my question is, I feel like for you can already answer this because you're kind of like in that route. And for me, I'm not, unless you have something different. But if you could take any different path than you have today, what would it have been or what would it be?
That's a great question. And believe it or not, I've actually thought of that type of question quite a bit in my life. And I always think about it of like, if there's anything about my past that I could change, what would I change? Or, what would I do differently career-wise or whatever? I always come to the same conclusion. For me, who I am today, I feel like who I am today is a complete amalgamation, culmination, conglomerate of all of the things that I've been through. Every mistake, every triumph, all kind of builds to who I am. So I don't think that I would take a different path. What I do think that I would encourage myself to do if I could go back and kind of be a little smarter is I would encourage myself to recognize at each step of the way how I'm further than I was before. And it there's that saying of like, wherever you are right now, you were for a lot of us, like where you are right now, you were praying or manifesting to try and be there years ago. So like, take pride or take excitement with where you are today.
Sure.
So that's, I think, what I would change. I would change like beating myself up so hard along the way for not being like at whatever my idea of the finish line was at the time. But yeah, that's kind of how I think about it. That's a really great question. What about you?
I like your answer. That's good. That's a little more insightful than I was going with it. But I love that about you. I should never expect anything less.
Yes, you're getting overcomplication from me every time.
For me, I think it would be like my musical journey. I would have embarked more in that. I mean, I love my nursing path. It's brought me, like you said, into just so many different relationships and walks of life that I would never change. But there's just also something, I mean, and you already know this about me, and even yourself has a little bit of just like this joy that is brought to me when I am doing anything related to singing. And I really wish I would have been able, and I mean, I still can, it's just harder to find, the time. And also it's harder to pick up a skill set at this age as opposed to if I would have started when I was younger, but would have loved to have like picked up an instrument to like accompany myself and just It's funny, Junior is always like sending me these like open mic nights and like trying to tell me to go. And I'm like, I want to. I mean, can I? I don't even know. And then I'm like, I don't even have anybody to like play the guitar for me if I wanted to sing a song or the
Mm-hmm.
piano. So anyway, it's just yeah, I think that would definitely be something I've always I think about it all the time, like taking a class to either pick up an instrument or just even learning musical theory more. So
Mm-hmm.
yeah.
That's funny. When I was younger, I thought I was going to be a famous singer, for those of you who may not know. But Sarah, she could be a famous singer. Her
No,
voice,
I wouldn't say that. I just think I could.
catch her in concert, guys. You'll catch her in concert.
It is
Let's get some
fun.
forward motion family out to the next
even
Phoenix
if
Women's Chorus
even
concert.
if my path, even if thank you, I appreciate the shout out. Phoenix Women's Chorus does have a concert coming up in May, and I will be letting you all know about it.
She's gonna have some solos.
I will be trying to have some solos for sure. So I just even if my path would have taken me to a street corner with a guitar, making, little to no money just as like something fun on the side, I would even appreciate that. That's how much I love music, and
I
just
mean, your
love.
path can take you there. There are plenty of street corners.
Yeah,
I'm just saying, like if you
I mean, if the right street corner comes along, you never know.
I still want us to do I still think that a city bus flash mob would be awesome, where we all get on the
Yes,
city bus
yes.
somewhere or the light rail or whatever, and we just start. We have our whole routine laid out, and we just
But
serenade
it needs to
people
be more
on
than
their.
just the two of us. I mean,
Yeah, it has to be people. Otherwise, we're just
yeah.
two weirdos on the light rail singing.
Seen those people on the train in New York. They were
Yeah,
singing
we're
our lyrics.
exactly we're those people. They'll have no idea about any of our passion. They'll be like,
Just get us
come here, baby. Come over here.
a little closer.
Don't sit, don't sit next to the crazy ladies. Oh goodness. We should probably do it both ways. We should do just us two as the crazy people and then have
And
something
then just to
a little bit
see,
more
we should
choreographed.
have some like a third party like recording just to get the visceral
Yeah.
reaction of the situation. Yeah, great.
Yeah, that'd be great. Oh man, good question. Good question.
Thank you.
I love
Yeah.
that. Made me think.
Mhm.
Well, if there is, I guess that there might be one thing that I would change also, and it would be starting to invest earlier.
Mhm.
If, hindsight's 2020, and honestly, if I had started investing when I was, Marcus's age or younger, Marcus is my son, that's something that I would go back, I think, and change. And so that definitely brings us into today's episode, and we're talking about investing basics. So we're going to touch on the basics of investing, right? What is it? What are some myths about investing that we can kind of bust? You know, and we have a few other topics. I don't want to give too much away, but we're going to talk a little bit about like, should I be investing or should I be saving? Like, right where you are in your life, like what should you be doing? And then we have some, other questions and things that we'll go over. So I want to just kind of jump right into what is investing. And I want to, I'm just going to kind of read a definition. I believe I pulled this definition from Investopedia, which is a really great resource. And we'll share some more resources later in this episode. Investing is defined as the act of committing money or capital to an endeavor with the expectation of obtaining an additional income or profit. So investing is taking money now with the expectation that it's going to create more money later. So taking money and doing something with it, right? An investment activity. There are many different investment activities. We'll talk about some of those. And the expectation is that that money is then going to produce a return on that investment, right? So a certain percentage of that investment, it's going to increase, and then you're going to have that money later. So investing in a lot of ways is the opposite of consuming, right? Because when you're consuming, you're going and, for instance, I have this water bottle. Buying this water bottle, I'm going to turn that around. No. So buying this water bottle, share the love, spread the love, was me consuming. So I needed the water bottle. They're a great deal at Costco. I got 2 of these for only $20. And so
I kind of do.
investment tip. No, not investment. But this water bottle was a consumer purchase, right? Because I bought this and now I'm using it. It is depreciating in value day after day, every time I use it. And it's never going to make me more money than what I spent on it. Unless one day, 40 years down the road, hydro flask or thermo flask, it's not even hydro flask, it's thermo flask. I got it at Costco, like I said, is, you know, an antique and is worth some type of collector money, right? But that chance is slim. So consuming is the opposite of investing. And we really do live in a consumer society. And so learning to invest and understanding what investment is extremely important in this society. And because you don't want to be at the end of your life and hoping that you're going to live on Social Security alone. If you're my age, you know, you can hold your breath for that Social Security. It's not going to be there. Okay. They're taking that money out of your check if you're a W-2 employee, and you're never going to see it again. So resolve yourself to that. You're never going to see it again, and start creating, you know, better opportunities for yourself. We live in a consumer society. So we spend money on liabilities, right? Things that cost money that do not create any type of income for us. As a society, the United States, as a society, that's the bulk of what we do. We import more than we ever export. And that's important to understand, because that from top down comes into who we are as individuals and how we kind of live our lives. You know, Sarah, when you think of investing, like what comes to mind as far as like what is investing? What do you think when if someone was to ask you like, well, what is investing? Like what would you say?
I would say, you know, investing is making some form of like a monetary value investment, whether it be in a stock market, in property, in a company that you really believe in, and you know that's, you know, not knowing but hoping, because with doing some research and hoping that it's going in a good direction, that there's going to be some kind of a percentage of return. It's, instead of just money sitting in a savings account, you're giving that money to somebody else or another for whatever, you know, in a company, or you're buying property that somebody's going to live in and you're going to rent out and return, you know, either have it paid off and or gaining a profit from at a higher rate than it would be if it was just sitting in a savings account.
Yeah, exactly. It's an educated guess that will ideally be profitable, right? You mentioned kind of not knowing exactly what's going to happen, right? We're going to talk a little bit about that later, because that's one of the biggest challenges that that people deal with when it comes to the potential for investing, is that there's risk, right? And there is risk. You know, I recently got a certification through McKinsey Corporation, which is a business consulting company, a global business consulting company, and I took this course through them, and it was about business. And one of the things that we really broke down in that course was risk. And it's like, what is risk? Risk is not knowing what the outcome is going to be. Like risk can have positive return, it can also have negative implications, right? But risk inherently is just the unknown. The risk is that I don't know what the outcome is going to be. The outcome can be great, the outcome can be terrible. And so one of the biggest myths about investing is that it's too risky. And, one of the things that I remember as a young person is, talking to someone who's very, very near and dear to me, and that I really looked up to financially for knowledge and things. My granddaddy, and I remember, he had, and I think I mentioned this in an episode prior, but like sometimes people say things and they might not even remember that they said it, or it might not even be like super integral to their life, but it sits with you and it sticks with you and it's like pivotal. And this was something that was pivotal for me, was my granddaddy saying like, "Oh, the stock market, it's too risky." And I remembered that at a young age, someone who I'm really, really, really looking up to financially, that told me the stock market is just too risky. And so it was something that I never even looked into trying to understand, because why would I do that? It's too risky. Like, but that's not, I don't know. I have something in my eye. That's not, I feel like I've done that like 80 times. That's not like the end all be all. And so I'm going to be using some tools on this episode because I want to use some resources. I'm not the end all be all to knowledge, and I use resources, and I'm not ashamed of that. So, one resource that I use is Schwab. And that's the brokerage that I personally use for my brokering of investments. And they have a knowledge base and a knowledge tool that has a lot of great information on investing. And so I'm going to read from their "Is investing risky?" And I just want to read a little bit, and then I kind of want us to talk a little bit about that. But investing has risks. The goal is to manage them, managing your risks. And that's where research and planning comes in, is managing your risk. We believe the best way to do this is to have a plan, know when you'll need the money, and diversify your portfolio. So further goes on to say, diversification, right? Diversity in your investments spreads your money around different types of investments, so you're not putting all of your eggs in one basket. You want to divide your money among stocks, bonds, and cash investments based on your risk tolerance and time. Dividing even further, you could include different types of stocks, such as large cap, or stocks where companies have a valuation of over $10 billion, or small caps, companies have a valuation of less than $2 billion, and international. And within those divisions, you could have stocks representing different sectors, for instance, technology and healthcare. The ultimate goal is to own investments that don't historically move in tandem. And so if you're watching, I want to share just a quick visual, because I want to show, if you're watching this, a chart where you can see what they're talking about. So this is a chart. The blue line is large cap equity. The red line is moderate portfolio. The yellow line is fixed income, and the gray line is cash equivalent. So you can see right down here. They do explain what each is. But we talked about large cap. So that's companies that have a valuation of over $10 billion. So think Coca-Cola, Microsoft, Amazon, right? And so you can see this blue line has gone up and down, right? So that's called volatility, right? So it's had fluctuation. And this is a 20-year chart. Since 97. So it's had more fluctuation than the others, but it also had the most potential gain, right? So a $100,000 investment in large cap equity, and if you just held it and didn't do anything with it for 20 years, now you're looking at that has Forexed itself, right? Now, if you would have tried to sell it, a few years later, in 2002, you could have lost money, or you could have made a little bit of money selling it in 99. You could have also been barely made in 2008, right? But over the full course of time, it's been the most profitable. Now, this is where you would put money that potentially you don't need for more than 5 to 10 years or 20 years. This is like where you put retirement retirement income, because there's going to be volatility and fluctuation. Now, then you have let's use cash equivalent, where it might be like CDs, or different bond funds that you could invest in. Now, it's had the least amount of gain, but it's also the safest, right? It barely went down ever at all. In this area, it went down just a tiny bit. But outside of that, it's pretty much steady growth, but a very small amount of growth, right? And so that's where you would potentially money that you would need in the short term. Right? I don't want to keep this money in cash. Maybe I would put it into a treasury bond or something along those lines, because I'm going to need it in a year, right? But I don't want it to go down in value. But I also don't want to put myself in a position where there's a huge market flop, and then I have to wait another 5 years before it makes sense for me to pull that money out. So I just wanted to share that visual, because I think that hopefully helps to understand what is meant by that diversity in your investment portfolio. So one of the biggest myths is that the stock market, or investing in general, people say this about real estate, all different types of things, is too risky. It's not too risky. It just takes education, thought, patience, and a plan, right? The second myth is, and stop me, Sarah, if you have anything to interject, of course. The second myth is, it's only for rich people. Investing is only for rich people. That is a huge, huge misunderstanding. Investing. Go ahead.
Oh no, I was gonna say, even on a basic level, people don't realize how you can, when you start your first job, and this, we know there's better, there are not necessarily better, but there are other ways than just a 401k.
Well, there are better ways, but a 401k it's a decent way to invest, for sure.
Right, especially when you're just starting out and you're worried about figuring it out on your own, and if that's something that your job is offering. I started my first what I would say real job when I was probably 19. I think I was 19, and my job offered 401k on the first day, and they matched, at the time it was 5%, now it's gone up to 6%, but they matched me 5%, and of whatever I put into my 401k, they would give me the same up to 5%. So
up to 5% of your income,
of my income,
they would match you 100%. So basically, they're giving you free money.
And I didn't even realize. I was like, sure, my dad was like, yep, sign up for that. And I was like, okay, like, kind of sucks. They're taking my money every paycheck, but
I can be using
whatever.
that.
Yeah, like I'm young, I guess but and I worked there for a good amount of time and did transition into a nurse there. And then I left and did some travel nursing for a few years. And I completely forgot about my 401k, but it was still there. I wasn't putting any more money into it, but it was still making money because it was still there with hospital. And then I never transferred it over or anything. A few years later, I came back, and I was just completely blown away at the amount of money that it had made. So even just from starting so young, it might not be a lot at first, but over time, it'll build up. And so
I don't know if I can find this. I think I can. I love calculators. I'm gonna do an example here, but no, that's really, you said a couple of things that were important, and I think one of the things that you said was you forgot about it, right? Because when you're going and you're signing up for it, it's like 5%, like that's could be $100, could be a couple $100, a few $100, depending on how much you make, right? Could be close to $1,000, and it's like, man, but I need that money. And then a few months go by and you see it coming out of your check, but you don't really connect that, like, I don't have that money anymore. And then a few years go by, and the next thing you know, and this money is growing exponentially, because of compound interest, which I'm compound interest is just this beautiful, amazing thing. But it's something that, bless your dad's heart for telling you, like, yeah, definitely sign up for that. Like, and then don't look back, right? Just sign up
Right.
for it and leave it.
Right.
And investing is not only for rich people, but investing is how rich people get and stay rich, right? How wealthy people get and stay wealthy. And investing is a lot of different things. It can be the stock market, it can be real estate, it can be a business, it can be treasury bonds, it can be, mutual funds, it can be a lot of different things. But making your money work for you is how you build wealth. And that's just the long and short of it. The next myth is that you're going to lose all your money. Now that, I think, is I don't know where that myth came from. If I'm being, really honest, I really don't know where it all started. But what I can say is it is a fear-based mentality that is, it's dangerous. It's dangerous to our culture. It's dangerous to our future. It's dangerous to individuals. Now, I've got a quick less than 3-minute video that I want to share. And I'm talking fast, but I'm going to share this because it really lends into exactly what we're talking about. This is compound interest. Now, remember, the myth here is you're going to lose all your money. And this is a TikTok that I did on compound interest, really using the S&P 500 or the Standard & Poor's 500 index as an example since 1957. So let's take a look.
Hey folks, let's talk about magic, okay? And when I'm talking about magic, I'm talking about compound interest. So that is one of the most magical things in our financial world, and compound interest is something that is extremely important to understand. So let's use the S&P 500 as an example. The S&P 500, or the Standard & Poor's 500 index, tracks the top 500 largest 500 companies in the United States, okay? So since 1957, it has returned an annualized return of about 10.5%. That means that when you buy shares of the S&P 500 every year, on average, since 1957, those shares have gone up about 10.5% in value by doing nothing, okay? So one share right now, let's use SPY as a ticker for an example, is trading at about $450 per share. So what happens when you buy one share of SPY? You open your brokerage account, you buy one share. Today it's trading at about $450 and you don't do anything. With 10.5% annualized interest, you're looking at $497 for that one share the next year. Okay, so that means that the share that you bought and that you didn't do anything with, next year it's going to be worth $497 at 10.5%. And then the year after that, $549. Then the year after that, $607. The year after that, $670, $741, $819, $905, $1,000. So that's magic, right? That's buying something with your money, not doing anything with it, and then it's worth more 10 years down the road. Okay? So let's think about, what if I bought one share and then I continued to buy shares and let them sit there and grow at 10.5% year over year? So let's just do.
All right, so I'm going to stop it there because I think it got the point across that now the S&P 500 has returned an average of 10.5% since 1957. Now, am I saying that it's a guarantee if you buy S&P 500 stock this year that it's definitely going to be worth 10.5% more next year? No, not necessarily. But that's also probably not the place for you to put money that you need next year, right? And that's where your whole plan comes in. And so that's where we have to really bust these myths. It's not too risky. There are risks that you can manage through a plan and through education. It's not only for rich people, but it is how the rich get richer. It is how the rich stay rich, and it is how the wealthy build wealth. And you're not going to lose all of your money. you need to put a plan together so that you are mitigating the most of your risk as possible. So those are some of the myths around investing that we really have to bust as young people and as older people, and as people who are just starting or expanding on our investment knowledge. That, I mean, Sarah, did you ever hear any of these risks, when you were kind of growing up?
Not really. I don't, I really didn't have anybody telling me about the stock market, investments, other than, yeah, get a 401k. It was,
Mm-hmm.
I didn't even really realize what a 401k was, which is investing into the stock market,
Sure, and mutual funds. Mm-hmm.
So, and I really like how what you said about like, the savings account, or not really the savings account, but putting this money here, maybe isn't the place for money that you need tomorrow or the next day, because you're looking for it to gain some interest, so it needs to sit in there for a little bit of time, but that by leaving it there over time, it's gonna give you more than if it were just sitting in a savings account somewhere.
Yep,
So I think
exactly.
I've been, have learned a few things recently about different savings accounts, even for myself, versus a savings
Mm-hmm.
account that I have through my bank, and one that, there's like online savings and different things like that, where the yield is
Mm-hmm.
like
Way
0.5%, which
better.
is, yeah, way better than a
Mm-hmm.
normal bank account, which is like 0.03% or something like that.
Yeah, a normal savings account won't even cover the inflationary loss of your purchasing power over the course of time, right? So
Right.
like if inflation is healthy and it's, 2 to 3% a year, so that means the cost of goods are going up 2 to 3% a year, but you have your money sitting in a savings account that's earning less than 0.5% a year. Your savings is literally actually losing purchasing power. It's devaluing because
Right.
it's not even keeping up with inflation. And then what's the bank doing with that money that's sitting in your savings account? They're investing it in the stock market
And making a lot of money.
and making a lot of money on it, right?
Yeah.
So, and it's interesting that you mentioned that, because I think there are of course people who were taught about the stock market, but I think for the vast majority of us, it was either it's risky, don't do it, or radio silence. I just, it was never talked about. And I think you and I are coming from right two different perspectives where I was told it was risky, and then it was like never talked about again. So that was the only education I had on it. And
Right.
it
And it
sounds
was
like
like,
you.
well, it was like, you should save your money. Don't spend your money on things that aren't needed.
Mhm.
Don't spend frivolously, don't eat out. But then it wasn't like, well, what am I doing with that extra money that I'm not spending by not doing those things? There was never really
Mhm.
any, okay, well, this is
Yeah,
what you should,
stick it in your mattress. Like, what do
right.
what do I do with it?
So yeah, it's like, okay, well, now I've got this money and I'm like, gotta, what do they say? Burning a hole in my pocket, and I gotta do
Burning a hole in
something
my
with.
pocket.
Oh, that's the other thing I like about, with a normal savings account that you have hooked to your bank account that you utilize every day. It's real easy to look over and be like, oh, I see that extra couple hundred over there. I'm gonna do this and that this weekend, or
Just
buy that
move
thing
that right on
right
over
on
here.
over. And I
Why
like
don't you just
having
slide into my checking account?
yeah, so I really like having an account that I don't even see every day. I almost forget about it. I have an automatic deposit that goes there every 2 weeks on the same day that I get paid. It goes
Yep.
over. I don't see it. It's never, out of sight, out of mind. It's not a large amount, but it's enough to know that I'm doing something, and it's in an
Yeah.
account that's earning more of a percentage than my normal bank account. Even doing things as small as that for people that are just starting off and don't know what to do.
100%.
Mm-hmm.
100%, and I love that out of sight, out of mind, because, I think that's something we talked about in a previous episode about kind of separating your checking and your savings. And you mentioned, basically earlier on this episode, it's like, once I set it up, it's kind of like, it hurts a little when you set it up, and then a couple weeks go by and you're just, and it's just, now I'm dealing with what I have here. And
Yep.
that's, that's what I'm budgeting off of. That's what I'm focusing on.
It's real funny
and it's
how
funny
you can, sorry, I was just going to say, it's just real funny how you can make the money that you have work for you. It's real funny how you think you need more money until you don't have an option but to work with what you got, how you can manage to make it work.
Yeah, you can make it work 100%.
Mhm.
I was just thinking of something that our guest Jeremy said on the last episode was, he kind of conditioned himself to live on a small amount of money, that he's like, I was able to do it before I was making more money. So why would I make this major change just because I've made more money? And, I can kind of delay that gratification. So when I'm ready to retire, or, or do whatever I need to do. No, that's awesome. And, I think one of after all the myths, and after we get past the myths, and folks are, kind of like, okay, I get it. I see the value in investing. I'm ready to do that, but should I be investing or should I be saving? Like, which one should I do? There are a lot of schools of thought of this. I'm shaking my camera. There are a lot of schools of thought in this. For me, what I believe is that you should be doing both. I believe that you should start investing with a very small amount while you're building your emergency fund. If you don't have an emergency fund, if you don't know what an emergency fund is, an emergency fund is savings, right, in a online high yield savings account that could cover a minimum of 6 months, ideally 1 year of your income, or your expenses, sorry, if something happened, right? So 6 months to a year of savings, of emergency fund, while you're building that, right? And you put together a plan to get there, if that's not where you are, and we have tools available and conversations available about how to get there. But while you're doing that, you should be starting to learn how to invest, and starting to invest. And you can do that with as little as $10 a week, $25 a week. I will never forget my first investment. I bought a share for like $44 a share of this water stock. It's a company that worked on water filtration at a industrial scale. I bought it for $44. It was I talked to Dean. I talked to Dean Grimes, and I learned he gave me a crash course in investing, and then on like investing, and talked to me about what he was invested in and how he makes his decisions. And he gave me some tools of like where to kind of research and learn more. Ended up doing some research. I found this stock, and I looked through it. I did my valuation. I felt like this is a good stock. I bought one share, $44. And for the next year, I didn't buy any more stock. I just consumed information and learned, and I made fake trades. I said, okay, what if I think that this would be a good one? I'm gonna buy this stock right today. So I would, write down like, this is what it was trading at. I bought this many shares. And then, I would check, how did I do? Right? How did I do? Is this stock doing well? Do I still believe in this company? Like, and I would make fake trades while I was learning. And then, in the course of a year, that stock doubled, which that's a good return on investment, right? So a lot of folks will say, man, I bet you wish you would have put 10,000 or 20,000 or 100,000 in that. Like, I mean, in hindsight, yeah, but at the time I was just learning, like, so
Yeah.
I was mitigating my risk, right? I
Right.
can handle losing $44 while I'm learning, but it'd be a really hard lesson to lose, $30,000 or whatever while you're learning. And so that's what I believe is you do both. You need to be saving and you need to have an emergency fund, but don't let that path of saving your emergency fund stop you from learning and participating in the market along the way. Now, you don't overdo it, don't get overzealous, but take that and learn. I think that's probably the most important thing that I would say. There's another question that I've gotten, believe it or not. And Sarah, if you want to kind of jump in with this question, I've actually gotten this question way more than once, and I've gone through the scenario in my head too. So
the question is, what if the world comes to an end and I end up, wasting my time investing and saving money? And I mean, I feel like that's probably a lot of our fears, right? Like, and at a time, I think we might have talked about this on previous episodes. It's like, well, I'm going to live for today. I worked hard for this money, so I'm going to spend this money, and tomorrow's not promised to me. Mm-hmm. Yeah, exactly. So what do you have for people that say that,
So it's a valid fear. And that's what it is, right? Let's call it for what it is. It is a fear because it's an unknown, and it's valid because, if you watch the news, I try and stay away from most news myself. It brings me down. But if you watch the news, you're bombarded with bad news all day. Like, if for CNN to tell it, like we're, 2 steps from the apocalypse tomorrow. Look out the window, like, are there plumes? Or, like, we don't know what's going on, right? But I guess I'll share a little story time, right? Like, the world comes to an end tomorrow, and everything's gone apocalyptic on us. Food is scarce, water's scarce. The politicians have fled to their underground bunkers, whatever. We're all left to fend for ourselves, right?
I'm sure Jeremy has one somewhere he's not telling us about.
Yeah, no, I know, right? We're going to have to get in that bunker.
Right.
When and if the world does come to an end, currency is not going to be money anyways, right? What you're going to need is food and protection, right? Food, shelter, protection. People are going to be trading, bullets and corn, for things like, no one's going to be like, how much do you have in the stock market? Can I, like, oh, you need some food. You got any shares of Microsoft that you can trade me for it? Or do you have $10? No one, like, our money's going to be useless. So
what you're saying is that I shouldn't get rid of the chickens.
Don't get rid of the chickens. Those eggs are going to be currency.
I know. Right? I already have people wanting to trade us for fish. I mean, it's a great.
Exactly. Barter, right? That's yes. That sounds like a good trade.
Right?
What kind of fish?
Something from Alaska.
Like salmon?
Well, hang on.
I mean, I don't know. I'm sure there's other fish in Alaska.
It is halibut from Alaska.
That's good fish. That's expensive fish. Well, see exactly what I'm saying. When the world comes to an end, you're going to be trading your eggs, right? And the zucchini that you got growing. No one's going to want your $100 bill. They're just not.
But I'm going to work on that.
I've got spinach sprouting in the back.
I've got basil grown wild. Somebody might want it.
Nice. Yeah, basil forever. Yes.
Pesto.
Yes. So what it comes down to in my mind is invest. Learn to invest and do it. Just in case the apocalypse doesn't come tomorrow or next week or next month, right? Or next year. And if it does, it doesn't matter because you're not going to need the money anyways. So that's kind of the way I think about that question, is like, I've kind of gone through it in my head and I'm just like, I mean, and then, there's the thought of, well, then I missed out on experiences. Well, you don't have to, because you can set up your investments where you have some short-term, some long-term, and you can invest in short-term for, to help with vacations and let your assets pay for your liabilities, right? If you have an investment that's making money for you, and you can use that for a vacation and that's what you want to use it for, do it.
Yeah.
like do it, right? Or you want to start a business and then you're able to expand your business and, travel to Mexico on the weekends because you're opening a kayak shop there too. Like,
Yeah.
there you go,
Sounds like a great life.
yeah, beautiful life, right? You've got it going. And so that's kind of the way I think about that question. I think like I said, I think it's a valid fear, but I think it's one that if we really are rational about it, if we're rational about the irrational, like if we're really rational about it, it's kind of like, yeah, it wouldn't matter anyways.
Yeah. Don't worry about it. Learn how to grow a garden.
Learn how to fish
Learn how to
and
fish.
raise chickens.
Hopefully, I see wild boars all the time in the South Mountains. So,
Are you serious?
oh yeah.
That's
At least,
scary. I've never seen them hiking. That
well,
would scare me.
I think they try not to be seen, but I just happened
Yeah,
to see one walking along one day. He was cute, but I heard they're mean, so I didn't get close.
they are. They are mean. Man.
Um,
Um, that's crazy. Okay.
yeah, right.
Wild boars.
Well, so if someone's just, starting off, what is there anything that they should do before they start investing? Sure.
Yeah. There definitely is. I mean, you absolutely want to set goals for, like, what are you trying to achieve through investing? Are you investing for retirement? Are you investing to buy a home? Are you investing to start a business? Like, what is it that your goals are? And check out our episode. You can check out the episode "Goal Setting Doesn't Work" for tips on successful goal setting. So the name's a little misleading, but set goals for what it is that you're looking to accomplish, and then understand your risk tolerance. If you're saving for something that is 30 years down the line, if you're investing for something that's 30 years down the line, say you're 30 years away from retirement, you can have a little bit of a higher risk tolerance because just like we saw in the chart, right? We know that like it might dip in the short term quite a bit, but over that course of time, you're going to be far beyond where you would have been without it. And so you really want to understand your risk tolerance, and then you want to manage that risk through diversity, right? What is this money for? When am I going to need it? And then understanding what type of investment makes the most sense for that goal. So those are a couple of things. And then research. I just can't say enough. Like, research and learn as much as you can about all of the different investment vehicles. Some different ways to invest are stocks, ETFs, mutual funds, treasury bonds, CDs or certificates of deposits, real estate, their 401k. There are so many different ways to invest, and all of these different ways can serve different purposes and different goals. So really do your research and understand, like, what different ways are there to invest, which ways fit with your goals, and how can you get into those type of investments. Make sure you have an emergency fund building, and while you're building your emergency fund, do make sure that you're investing, starting small and not kind of being lopsided with your investments in your emergency fund. And then start small and get a hang of the tools and the process, right? If you're starting to invest in the stock market, you're going to want to understand like how your investment tool works, right? When I bought that one share of stock, it was my first experience with using the Schwab interface, right? So one thing that I was trying to learn is like, okay, when I want to sell this stock, how would I even do that, right? How do I buy a stock? Where do I look for more information on this? What if I wanted to buy a mutual fund? Could I do that through this account, really? And just kind of learning all of the different ins and outs of the actual tool itself. One super, super important thing is get a hold of your emotions. Right now, February 23rd, 2022, we're experiencing, a market correction, a really, really heavy market correction. And there are a lot of people that are panicking, right? And I was actually talking with with someone recently, and they kind of brought it up, and I was like, we were both talking about it, but it's like, there were a lot of like investment gurus and crypto gurus and everyone talking about, oh, and you can do this and you got to do that. And you got, oh yeah. And I can, look how much I made here. Look how much I made. It seems really, really quiet with the market way down how it is. Crypto's down too, right?
Mm-hmm.
All of the gurus are like super quiet, because it's like, yeah, it's super easy to invest in an up market. We're in a crazy bull run, right, in the market, like just, especially tech stocks just going crazy. And it's like, but as that starts to correct and pull back, well, let me just be quiet, because I'm not quite sure. I think I'm going to sell while it's down. It's like, no, don't sell while it's down, right?
Yeah.
And like, so it's really quiet while that's happening, because people, maybe we're investing with emotion and investing with only social investing, right? Like, I heard about this stock, it sounds cool, so I'm going to buy it. I'm not going to do my due diligence, my real research. I don't really know much about the company. I don't really believe in the company long term.
Mm-hmm.
I'm just trying to make a quick buck. And then as that strategy doesn't work as well in a bear market, right, as it starts to pull back. So get a hold of your emotions, because when you're a true investor, you're gonna find that there's often power in doing nothing, right? As we were looking at that chart earlier, and we had that down dip in, I think it was like 97 ish, right? And then obviously we had a down dip in like 2007, 2008.
Right.
People who sold during those markets, they potentially lost
money.
a lot of money. Whereas if that plan had been outlaid and it was like, well, okay, it's down, I'll either buy more of the stocks that I believe in, or I'll just leave it. And then, 5 years down the road, 10 years down the road, it's exponentially greater. But folks who sold during that down market out of emotion and fear really lost, right? And so that's where, when you're investing, you want to make sure that you're not investing money in higher risk assets that you need right now, right? Or next year or the year after. And then have a plan. Understand, like, what percentage are you allocating within, and this is, this may go deep for some, and please feel free to reach out, info@forwardmotionaz.org. Happy to have conversations on the side, or set you up with coaching. But how are you allocating different percentages of your portfolio? Like, what's going to ETFs, what's going to mutual funds, what's going to bonds, what's going, what are you doing with real estate, what's going into actual stocks, and then what's going into big companies, small companies, this industry set, that industry set, right? Sectors, these different sectors. And so you want to make sure that you have a plan that's backed up by historical trends, and then also understand what the expected future outlook is. So that's kind of like is there something I should be doing before I'm investing? Yeah, those are the things that you should do. Set goals, understand your risk, and mitigate that risk based by diversity. Research and learn, take it slow, make sure you have your emergency fund, and get a hold of your emotions. That's a really, really, really big one, and have a plan. So those are kind of the things that you should have set out when it's time for you to start investing.
I think that's great, because I think something you say sometimes, the fear of missing out on things gets people, can cause people to jump into something too quickly, invest in something they're not fully aware of, haven't researched fully, or they're just not ready to, because they don't even have a base savings for their emergency fund that they could access a lot easier than, and you don't want to have to cash out. That's the point of investing, right? You don't want to have to cash out your bonds or whatever just because you've made some money on it, or, and that's another story. But so, yeah, it's kind of just reminding us that you can take it slow, you can research, you can learn. This can be a goal that you're setting to get to the point where you can invest. It's a process, but doing all of those things is one step further into meeting the goal of being able to invest in a way that it's actually going to be beneficial and meaningful.
Yeah. Yeah, 100%. Because a lot of folks' introduction to investment very recently, right? We've had this huge crypto boom. Crypto has a low cost of entry, right? You can buy these coins that are 0.00000000000001, right? Cents per. And any a small movement can be a huge gain for you, if depending on how much you put in. But a lot of folks have started in that and gotten into a belief or a habit that you don't need to understand what this asset does or what it's used for or what the utility is or why you should buy it. You just kind of look at this chart and hear someone say, well, I put $100 in and it's doubled, so you should put some money in too. And that culture starts to breed, and I've seen it breeding, and I've heard these conversations, and it makes me so like scared for people, because I'm like, yeah, the getting is good, and maybe it does work. But you know what? I could go to Vegas and put 5,000 on black at a table, and maybe it hits, right?
Right.
That's the same thing. But when it doesn't, and gosh, I in sales leadership, I always used to say, when I was a sales trainer and I'd be training a group, and I'd have someone who's just kind of struggling through the training program, maybe, newer to sales, doesn't have, as much experience or skill. And they get on their first phone call, and that phone call is a sale. And a lot of people would probably think like, Amanda, like, why are you hating? But from experience, I'm like, that's the worst thing that could happen, because this person just fumbled through this call, didn't,
That's how it goes.
and then they got a sale, and now it's like,
You're
that's
like,
how it goes, right? If you cut corners and it works, or if you're don't do well, and then don't do the due diligence or things you're supposed to, and it works, in the back of your mind and your subconscious, no matter what you do, there's a part of you that's going to believe like, oh, this works. And the same thing with this whole crypto boom, or even this the bull market with a lot of the tech stocks and other sectors as well. It's like, oh, that's how it works. I don't need to research a company. I don't need to understand their financials. I don't need to understand who's running the company, who the CEO is, who the CFO is, what their future and their vision is. Like, I don't need to know any of that. I just need to know that my friend bought this stock, it went up, I'm going to do it too. And it's going to go up for me. And I'm probably going to be a millionaire, doing these calculations of like, I bought this XYZ coin, and I don't know if that's actually a coin. If it is, I'm not advocating for a coin, but I bought XYZ coin, and, I put, X dollars in it, and now it's X times 3. So I'm just going to buy more right now while it's 3x what I bought it for the first time. Oh goodness, that's terrifying, right? So I could go on this, but yeah, there are some things you got to do.
So would one of those things be, especially like for somebody just starting out, do you think a financial advisor is something that everybody needs? Is it something that anyone needs? What are your thoughts on that?
That's a really good question, because the answer is there are pros and cons to a financial advisor. A financial advisor is someone who is certified to and will manage your investments on your behalf. So pros might be with that they're knowledgeable, right? They have access to the tools. You don't have to necessarily learn how to use the tools. You don't have to do all the research on the companies, and they're going to tell you what is good to invest in, and they'll move funds around for you when needed. The cons there are, you don't have to do the research into the companies. You don't really have to know, what's going on. You don't have to be involved. So the same pros are cons. And what also turns into a con is, and this is something that there are great financial advisors out there, and I know some good financial advisors, but there are also some who are selfish. There are some who make trades that that benefit them over the client, or who just aren't as actively involved as they should be, and so those are some of the things that you want to look out for. And then also, to have a financial advisor, depending on the firm, you might need a much larger minimum investment. It might be 500, it might be 5,000. I've seen as high as 25 or 50 or 100,000 or more, depending on depending on what company you're going with, and the level of advisement. And so being able to start small, being able to start with as little as $10, buying a slice. I can take $10 and buy a slice of Microsoft stock through Schwab, right? I can take $50 and buy a slice of Amazon stock through Schwab. An advisor, you're not going to be able to do that in any cases that I'm aware of, but definitely in most cases, you're definitely not going to be able to do that. An Amazon stock, I think, is up around $3,000 right now a share. Wow. And so hope they might be doing a split. Google's getting ready to do a 20-to-1 stock split. So in June, you'll be able to buy Google stock for basically divided by 20 what it is today. It's going to be the same, and one day I guess we could talk about stock splits. So basically, like if their stock is going for $100 a share today, and they did 100-to-1 stock split, then you could buy a share for $1 instead of needing $100 to buy a share. But there'd also be 100 times more shares available for overall purchase in the market. So it doesn't change their valuation or how much the company's worth. It just gives access to smaller investors to be able to get in. As the stock price starts to grow exponentially, it gets harder for single investors or smaller investors, unless you have a tool like Schwab that gives you the ability for slices, or some others do as well. If you don't have $3,000, you can't play, right? It's like, well, you got to wait until you have $3,000, as opposed to, no, I can take my $50 and still get into that company. So those are some of the pros and cons. There's also fees for brokering trades through financial advisors. They're going to charge you because you have to pay them, right? So anytime they make changes or do anything for you, you're going to have to pay them. Whereas most reputable brokerages now, for instance, Schwab, TD Ameritrade, I think E-Trade, you don't pay for each individual trade. So that's something also to think about. Yeah, so those are kind of some of the pros and cons. Are there any that maybe I missed out, or that you've heard of or had questions on or thought about? Or
no, I think you hit some pretty big points, some stuff that I hadn't even thought about. So yeah. Great. Thank you.
Nice. So one thing I wanted to share are some of the different ways to invest. This episode is on investing basics. We'll definitely have some episodes that are much more in depth on individual topics, but a lot of folks are like, well, where can I even do this investing thing, right? I hear people talking about brokerage accounts. Like, what is that, right? So online brokers, so you hear me mention Schwab. I don't get paid by Schwab, but I use Schwab, and I really love the tool. I've seen many other tools, and I prefer Schwab's tool. So that's why you hear me talking about Schwab. There's TD Ameritrade, there's Ally Financial, there's Fidelity, there are others as well, just regular online brokers. And then, there are some that are like, Robinhood is another. I'm not a big advocate of Robinhood. It doesn't really give you access to the full market. But that's one. So then there's also robo advisors. So the online brokers you're going to be doing it. Now, some of the online brokers do have their own robo advisors as well, and do have advisors that you can actually, like, I could have a Schwab advisor if I wanted, but you do have to have a certain minimum in order to be able to use one of their advisors. And then there's robo advisors. So basically, this is a tool that has an algorithm that is making investment decisions for you. you take like a quiz, you tell it, what your risk tolerance is and what your goals are when you plan on needing this money, all of these things. And then the robot, the algorithm, right, kind of makes these decisions for you. So some that you might hear about are like Betterment. Schwab has Intelligent Portfolio. So those are like robo advisors. And then you have your employee sponsored, right? So you have 401k, 403b, and then you have employee stock purchase program, right? Some companies give you stock options or an employee stock purchase program. And then you have independent financial advisors, right? So there are financial advisors that have their own practice that you can find. They're certified and able to trade on your behalf. So those are some of the different ways to get into the market. When it comes to cryptocurrency, so there's crypto.com and then there's Coinbase are two of the biggest players. I've used both. Some of you guys hear me talking about crypto. I don't think that crypto is bad. I hold some crypto. It's a very small percentage of my portfolio, but I hold crypto. I've used both Coinbase. I use both Coinbase and crypto.com. I prefer crypto.com. It's more intuitive. It's just a better platform in my opinion. But that's another those are some options in all of those different ways. Now, online brokers, I recommend creating an online brokerage account to start out. And then as you're learning and you're able to use their tools, their knowledge base, you're getting books, you're reading and you're watching, videos and listening to podcasts and maybe having a financial education coach, all of these different things while you're learning, and then having access to that tool is something that I definitely recommend. Yeah. Cool. We went over a lot.
Yeah, it was good. Taking notes myself over here.
I wanna use this calculator to do just this quick example. And I've had this up since we were talking about that. So I'm just gonna plug in kind of the numbers here so that we can kind of get a good look at 401k, because 401k gets knocked, but honestly, like even if wherever you are, just make sure that if someone's going to give you free money,
right,
take the free money. Like don't not take free money. That doesn't make sense. So let's say you're 30 years old. Let's use a moderate age, and let's say you're making $50,000 a year, and you're just starting your 401k. You've never done it. You've never bought or put into a 401k, and you're barely getting started. So let's say that you're going to take just 5% of your income because your employer matches 5%, or sorry, your employer matches 100% up to 5%. Okay. So that means that if you put 5% in of your current salary, they're going to put that same amount in. But if you any more above 5% that you contribute, they're not going to match you anymore. So that's what that means. Let's say you want to retire when you're 65, hopefully it's younger than that, but if 65 is the age, and let's say you're going to live into your 85, and you're expecting a 3% a year salary increase, and then the expected annual return is on that 401k. How much money do you expect for that 401k to give you a return on your investment each year? So we're going to use an expected return of 6%. That's pretty modest, but I always like to err on the side of caution. And then we're going to say that we're expecting inflation to be 3% a year. So basically, honestly, you're just getting really a 3% return if you account for inflation, right? So then we calculate that. And what this is going to say here is at the retirement age of 65, your balance is going to be $836,399. which is equivalent to $297,000 of purchasing power today. So what this calculator has done is it said, I'm going to take into account inflation over the course of time as well. So this $800,000 is really like $300,000. Just like $100,000 today, if I go back to my grandmother's time, $100,000 is, was like $500,000 or more, right? So if you are then, and then it goes into, if you're going to withdraw monthly $5,992 a month, that's what would be able to be withdrawn in retirement until you're 85. At 65, this is equivalent to, and it gives you again what that purchasing power is. And then at 85, this would be the purchasing power. So I think several episodes ago, I kind of talked about how I was saying like $1 million really isn't a lot of money. Like it sounds like a lot of money, but when we're talking about money today for the future, $1 million really isn't a lot of money, because maybe it sounds like a lot of volume of money, but what you're going to be able to buy, we can see that today with the housing market. Like what you can buy today, right, as far as a house for $450,000 is way different than what you could get in 1990 for that right amount of money. No right? Kidding. It's not the same. Yeah. And so I want to go back and I want to just make one quick change. So let's say that you started just 5 years, just 10 years earlier. Let's say that you started just 10 years earlier, nothing else changed. You started with $0, we're using all of the same numbers. Let's calculate that. Now we've gained almost a full $1 million.
Yeah. Wow.
By just starting to invest 10 years earlier, the same amount. And now your purchasing power, your withdrawal is $12,000, which is equal to $3,200. And this is based on, 3% annual inflation, or $1,700 at the age of 85. So that's a big difference, right? So that's saying, if I'm going to withdraw annually $150,000, that's going to be equal to living on about $40,000 today, right, at age 85 or 65, and about $22,000 at age 85 based on inflation. So when we're talking about investing being a necessity, not an option, that's what I'm talking about. That's what we're talking about. The purchasing power that you have today is not the purchasing power you'll have tomorrow. And unless your money's working for you, you're hustling backwards. If your money's not working for you while you're sleeping, you're hustling backwards. That's 100% bottom line. That's just how it is. So I want to share some resources that I use and that I would love to share with you all. So NerdWallet is a resource that I use. They have a great blog. They've got a lot of articles, a lot of great information on investing and money in general. Yahoo Finance. I use Yahoo Finance to begin my research on stocks and on companies. They have a lot of great information there and analysis. Investopedia is another website. Great blog, lots of great articles and information about all things investment and money. Schwab.com has a phenomenal learning tool that has a lot of videos and articles and blog, and the Get Your Money Right podcast.
Yeah, right here.
Forward Motion, Get Your Money Right podcast. You can get a lot of this information right here with us as well. So keep listening. Make sure you subscribe. I've had fun on this episode. How about you, Sarah?
Yes, me too. I have to say one thing when you, just because it's a How I Met Your Mother reference, Investopedia instead of
Investopedia. I always called it Investopia for like years. I called it Investopia, like the universe of investing. And then one day I was like on the site and I looked and I read it like 10 times and I was like, Investopedia. Oh, it's like an investment encyclopedia. I was way off. Like
You
an
know, when Ted goes
encyclopedia.
around and he's like, my encyclopedia, and he doesn't, never mind. Never, not a How I Met Your Mother watcher.
Encyclopedia. I watched it. I watched the whole thing, but I haven't watched it like multiple times, like
No?
Friends
Okay.
or Bones or anything like that.
That's all right. There's now a How I Met Your
How
Father.
is it How I Met Your Father?
Yep, with Hilary Duff. I haven't watched any of it yet, but
I knew they were doing a spin-off.
yeah.
Interesting.
Anyway, totally off
Yeah, we'll
topic.
see how that goes.
Cool.
No. Yeah, I don't know how we
Yeah.
got there.
My
Follow
fault.
us for more. So
Always my
at
fault.
Forward Motion, no, half the time it's my fault. At Forward Motion AZ on Instagram and Facebook. Moving forward, one family at a time on YouTube. We are a nonprofit organization. You can donate at forwardmotionaz.org/donate. And I'm actually on TikTok now, so I'm dropping forward motion financial literacy, career development stuff on TikTok.
Knowledge.
Dropping that knowledge.
Knowledge.
Money Manda is my TikTok handle.
Money
You can
Manda.
find me at A Miller 4800.
Love it. Love it. All right, guys. Thanks
Oh,
for watching. If anybody's
y'all have a
out
great
there.
one. Are you there? We'll see you next time.
Bye.